record. Okay, recording now. Today is February 22nd, 2022. So chapter 6 homework is due next Wednesday. The project after that, the decks are cleared and you're going to focus on the project. The financial statement analysis is due Monday. And the business model analysis is due Tuesday. And when you turn that in, you're turning in both the PowerPoint and the detailed notes. And then for the 4:30 section next week, you'll come and your teams will do a presentation. And if you can't do it at 4:30 to 5:30 on Tuesday, you guys can upload a video at about a, I give the instructions on how long the video can be. I think it's up to 12 to 15 minutes long. So 12 to 14 minutes long. Okay. So it's okay not to do your presentation on Tuesday, but by Tuesday night, you need to upload your video of your team talking through your PowerPoints. You also need to upload your PowerPoints with the detailed notes and then the appendix. Okay. Any questions on that? All right. Okay. So class test results are posted. You can still do your exam conferences. That's fine. I'm not sure I'll be able to do the conferences tomorrow during the test, but if you haven't had a chance to have a conference, let me know. Okay. And test is tomorrow. All right. So how were you guys with the practice exam? So do you have any questions on or want to go over anything on the practice exam?
Yeah, that would be nice.
Okay. Anything in particular, Beza?
No, but what we did last time worked for me.
For the first test?
Yeah.
All right.
And that was really helpful.
Okay. Okay. Well, that's good to know. Let's see if we can bring that up. 4, 5, and 6. No, I don't want the exam. I want the practice exam. I don't want to show you guys the exam. All right. Okay. So before we go there, this is the big test where you really have to know all the journal entries. And so it adds up to, oh, I didn't put the other one, the closing journal entries. So chapter 4 has 11 journal entries. Chapter 5 has 7 perpetual for sales. Actually, it could be either order, but usually purchases and sales, and then periodic purchases and sales. Closing journal entry, all the adjusting journal entry, and then the statements are the multi-step income statement and the cost of goods sold. Okay, so it's a lot. I mean, it's 25 journal entries. So I don't know any other way to learn them but by making flashcards or just doing a lot of drill. I know a lot of times students like to just read the textbook, but I would say spend your time between now and tomorrow doing more drill, because I think that's going to make a difference for you. All right, and let's see. Okay, so let's switch to the practice exam and let's see how you guys do. Let's just quiz you right now on that. All right, so we got this. So this is what I just went over, right? Chapter material, chapter examples, end of chapter sample problems. Those are great because they have the solution right there. And practice homework that I put out on Wiley Plus, and that'll be good through tonight. And then the journal entries, cost of goods sold, multi-step, know your ratios and what they mean. So you guys a lot of you have already started talking about the ratios in your FS3B, your status report. So that's great. And typically the practice exam's a little long, so don't panic. Hang on, I'm going to just grab the exam. I want to make sure before I promise you anything. Okay, sorry. So you can see on the practice exam that you have a chart of accounts. And again, you don't need to use the numbers, but you do need to know that they're there, okay? And so when you're doing the practice exam, you're not going to get a chart of accounts, but you might get other clues along the way, like a trial balance. So use that like your chart of accounts, okay? And when I say that, I'm specifically referring to statements. So when you're doing statements, if you have a chart of accounts, or if you have a normal trial balance with assets, liabilities, stockholders' equity, revenue, and expenses, that's the right order. So that should give you a big hint, and that'll help you when you do your statements. So you know what comes first and what comes second. Okay. All right. So let's do this one. And let's do the first one. So this is lock-free, has the following balances in selected accounts on December 31st, 2011. Okay. All the accounts have been gathered. Okay. Did we give you any instructions? Yes. Go to the instructions first. Okay. Prepare adjusting journal entries for these 7 items. Do not book the original journal entry. Okay. Just the adjusting journal entry. So there was an original journal entry that created these account balances. So maybe they bought equipment, they debited equipment and credited cash or accounts payable. But you don't need to worry about that first journal entry. We just want the adjusting journal entry. Okay. So let's look at the first one. Lock-free company borrowed $20,000 by signing a 12% one-year note on September 1st, 2011. Without looking at your practice exam, what are you going to do here? What is the problem asking you here? So what I want you to do for the exam tomorrow is I want you to read the problem and immediately know, oh, this is one of those kind of problems, okay? So if you know what the adjusting entry is, not the dollar amount, but just know which adjusting journal entry it is, put it in the chat. So they borrowed the note on September 1st. It's a 12% note. What kind of adjusting journal entry are we working with here? And if you don't know, put that in the chat. Beza, that's the original journal entry. I want the adjusting journal entry. So Colby, that's correct. Interest expense, interest payable. Okay. All right. So they signed a note that 12% is the annual interest rate. And we want to make sure that we book the interest owed. How much time has passed? So prepare adjusting journal entries for the 7 items described above as of December 31st. How much time has gone by? Sophie, absolutely right. And what you're accruing is the interest. Okay. So how much time has gone by? 4 months. And Sophia, can you give me those 4 months? Say which ones they are.
Wait, so does it have to do with the other page or is it with this?
It's right here, yeah.
Okay. So it would be September, right? And then
Correct.
would it be the next 4 months or next 3 months? October, November, December, or would it be?
Perfect.
Yeah, gotcha.
So yeah, so that's where it gets really tricky, because you see September and you think, oh, October, November, December, but then you have to realize that it's September 1, so you still have to count September 1 through 30, October 1 through 31st. So it's 4 months. Okay, good. And the journal entry is, as Colby said, interest expense debit, interest payable credit. Okay. Account of supplies. Don't even read any further. What's the journal entry going to be? What's the debit? What's the credit? Without doing the dollars. If it's a supply problem, what is it going to be? Sophia, yes, good. Debit supplies expense, credit supplies, yay. Colby, yes, okay. So do you see do you see how I'm doing this? There's only 7 journals, right? Now you got to figure out the dollar amounts, and I can help you with that, or we can, you already know that, but half the battle is knowing what that journal entry is. And you'll notice those 2 journal entries that are already in the chat: debit interest expense, credit interest payable. The second one is debit supplies expense, credit supplies. No adjusting journal entry from chapter 4 is going to involve the cash account. Just not going to happen. So if you think cash is involved, you're probably thinking of the original entry, but not the adjusting entry. Okay. Next one, equipment was purchased. Depreciation is booked annually. Okay. All right. So what's the journal entry for depreciation? Good, right, Colby. Debit depreciation expense, credit accumulated depreciation. Okay. Now, how much depreciation will it be? Let's stop and come up with the dollar amounts for this one. And how do you do it? It costs 70,000. Okay. Costs 70,000. What are you going to do? How are you going to depreciate that 70,000? How much? How much time, how much life is it in this asset?
10 years.
It will be 10 years. So you're going to divide 70,000 by 10. That's going to give you 7,000, right? But that's not the answer. Is that the answer? I think it might be. Let's go back and look. They purchased it on January 1st, 2009. So they purchased it a while ago, a couple of years ago. The useful life is, yeah, so it will be 7,000. So you don't have to prorate it to a month. Okay, that works good. Okay. Next one, lock-free paid $26.40 for 12 months of insurance. Okay, insurance problem. What's that going to be? What's the journal entry? Debit insurance expense and credit. Leanne, give me the whole account title for the prepaid. And Sophia, correct, but what is the journal? What is the account titles? So debit insurance expense, credit prepaid insurance. Good, okay. And whoops, I keep switching pages. And on December 1st, Lock-Free collected $40,000 for consulting to be performed from December 1st through April 30th. Oh, should we go back to prepaid insurance? Okay, I'm just reading, I'm just following along in the chat. Okay, so you've got the journal entry for number 4. It's debit insurance expense, credit prepaid insurance. They prepaid for 12 months starting June 1st. Okay, so how much as of December 31st? They only book adjusting entries annually. Okay, they only book them annually. So how much time has gone by? How many months is it? 7 months or 6 months? We have two answers. Colby says 7, Leanne says 6. So how many months has gone by from June 1st to December 31st? 7. Okay, we got it. All right. So what you do is you take the 2640, divide it by 12, and then multiply it by the 7 months. And that's your journal entry. Does that make sense to everybody? 2640 divided by 12 is what? I don't know. 2640, oops, is 220 and then times 7. So it's 1540 is the answer. All right. All right, next one. On December 1st, Lockfree collected 40,000 for consulting services to be performed. So it's in the future. December 1 through April 30. Assume an equal amount is earned for each month. Okay, so we're going to have to do the same thing, but let's do the journal entry first. So on December 1st, they would have gotten the cash and they would have credited unearned revenue. And now we have to recognize how much revenue they've earned as of December 31st. So the journal entry, that's correct. Colby, unearned service revenue, debit, and credit service revenue. Good. So how much revenue have they earned? 40,000 divided by how many months? From December 1st to April 30th. How many months is that? So if you count off, yes, you're correct. Count off for me, please, the months.
So it'd be December, January, February, March, and then April. That's
Yeah,
fine.
5 months. If you're in the test tomorrow and you don't remember your months, I'll write them on the board. So just ask me if you get stuck. Okay, so don't worry about that. All right, so we're going to take 40,000 divided by 5. And that's going to be equal to 2,000? No, how much? 8,000. How about we do that right? Hello. Okay, so it's 8,000 a month. So at the end of December, they're going to debit unearned revenue and credit service revenue. Okay, so they've earned 1 month's worth. Okay. Okay, Lockfree performed, past tense, performed consulting services for a client in December. The client will be billed $4,600. That journal entry you learned in chapter 3, what is it? Yeah, accounts receivable and service revenue, Colby, I think. Let's see, what kind of business is this? It doesn't tell you, but assume it's service revenue because we haven't learned sales yet for chapter 4. Okay. All right. And finally, Lockfree pays its employees' salaries. Okay, salary problem. What's the adjusting journal entry? What's the debit? What's the credit? I owe my employees' salaries. What's the debit for salary and what's the credit? Salary expense, salary payable, Sophia, salary expense, correct. What's the credit, Sophia? Which kind of payable? You got to pick one. Salary, got it. Okay, you guys are good. All right, now these sorts of problems, I actually like to almost draw and sit there and go Monday, Tuesday, Wednesday, Thursday, Friday, that kind of a thing. All right. Lockfree pays 10,000 every Monday for the preceding 5-day week. Okay. Monday, Tuesday, Wednesday, Thursday, Friday. So if they pay 10,000 for a 5-day week, how much per day do they pay? What's the daily amount? Leanne, that's correct. 2,000 a day. All right. So on Monday, December 29th, employees were paid for the week ending December 26th. All employees worked the last 3 days of 2011. All right, so we know that Monday was December 29th. Tuesday's December 30. Wednesday is December 31st. So as of December 31st, Lock-Free owes its employees for 3 days of work. We already know the journal entry, salary expense, salary payable, and what's the dollar amount? Leanne, you're correct. Colby, you're correct. 6,000, okay? Because as of December 31st, the company's going to produce financial statements, and it has to recognize I owe my employees $6,000 as of this day. We haven't paid them yet. What does that accomplish? What do any of these journal entries accomplish? You're trying to recognize any revenue and any expenses that you have not paid or have not have earned, as in revenue, have incurred a cost like an expense, but you haven't done the transaction yet. And so that's all part of that matching principle. You know, you recognize revenue when it's earned, not when you're paid. You recognize expenses when they're incurred. So our employees worked, we have incurred those expenses, we owe our employees, we have to recognize a debit salary expense, credit salary payable. Okay, all right. Now you could, I just want to go back here one more time. The note problem is probably always going to be a note. The supplies problem, the equipment could be furniture, it could be a building, it doesn't have to always be equipment. Insurance that's been prepaid, that's one example of a prepaid. The other example is prepaid rent. So it could be either of those. Consulting services is going to be the same, salary is going to be the same. Okay, so there's a little room for variation. On the interest expense problem, interest expense, interest payable, you could have other expenses. You could say, you know, we got the gas and electric bill that we used for the last month, you know, so we have to recognize debit, gas expense, credit, accounts payable. Okay. All right, and so if you get this problem, first off, remember my advice. If it's in the right order, that's going to help you with any statements. And then what I like to do is I like to draw a line under retained earnings right here. I'm just going to highlight it because I don't have a line to draw. Ah, that was a mistake. Okay, I'm going to, so everything below this line, I'm going to close out. Okay, and that just guides me on what my closing journal entries are. So first journal entry is to clear out service revenue. It has a normal credit balance. So when I clear it out with my closing journal entries, I'm going to debit service revenue and credit income summary. Then I'm going to credit salaries expense. I'm going to credit miscellaneous expense. I'm going to credit supplies expense. And then the total will be a debit to income summary. And then I'm going to take the difference between these. I'm going to credit, sorry, I'm going to debit income summary and credit retained earnings. Then I'm going to close dividends directly to retained earnings, debit retained earnings, credit dividends, and then I'm done with my closing entries. Okay. All right. All right. Does anybody have any questions on the adjusting journal entries? Debit income summary for all? No, not quite, Leanne. Let me pull up the solution on the closing journal entries and we'll kind of walk through that. Hang on. Oh, there you are. Okay. All right. So let's go back to, those were the adjusting journal entries and the calculations there. And then we'll go, and then this is where I laid out Monday, Tuesday, Wednesday. And I always do that for these problems because it's really easy to count them wrong. Okay, so first journal entry, debit service revenue, credit income summary. Second journal entry, credit each and every expense account and debit income summary. Third journal entry, we just take the difference here. So I don't think I show you income summary. That's too bad. Income summary had a credit balance of 4,300 and a debit balance of 4,000. So it after the second entry, it has a net balance of $300 credit. Okay. So something to keep in mind. So it has a credit balance of 300 after the second entry. So now we want to close out income summary, debit income summary, credit retained earnings. So that increases retained earnings, right? Just like we do on the retained earnings statement, beginning balance plus net income minus dividends equals ending balance, okay? And then finally, the last entry doesn't have income summary. It's just debit retained earnings and credit dividends, and that's your ending balance. Whoops, on the wrong side. Oh my gosh, I can't believe I did that. Should be the credit side. See if I can repair my wicked ways here. Let's see. Get rid of that. Nope, I don't have it at my fingertips. Nope, I'll have to fix it and revise it. But know that this is a credit balance of 2,100. So, oh, you know what I can do? I can do it right on the exam. Let's see if I can do that. Text. All right. All right. It's not going to let me. Who wants to do that? Let's see. Let's just do this. No, I don't want to add an image. Well, you guys get the idea. This is no good. But this is the right ending balance. All right. So let's go back to the other exam. Perpetual journal entries. Now, you guys remember from last week that I shared with you that we need to look at that one page in our textbook that has all the perpetual journal entries in it. So, and then it has all the, and that's it. That's in your textbook, but it's also on my PowerPoint. So let me see if I can bring that up here. All right, here we go. Okay, so here's the perpetual journal entries, the purchases. And you guys can use merchandise inventory or you can just use inventory. Either one is fine with me. So when you purchase something, you debit inventory and credit accounts payable, unless the problem tells you they paid with cash, which of course most of them don't. In perpetual, when you pay the freight bill, if you pay the freight bill, do you guys remember when a company, the purchasing company pays the freight bill? And that has to do with the freight terms. So the company, the buying company pays the freight bill. When does the buying company? The terms are FOB what? When the buying company pays. It does depend on what they negotiate. And then once they've negotiated, the invoice will say what the terms are.
Was it FOB shipping point?
You are correct. So, and what that means is ownership transfers at the shipping point. Okay. So FOB, I hit send to shipping point means ownership transfers at the shipping point, and that means buyer owns it when it leaves the seller. Buyer pays freight. Okay. If it's FOB destination, the seller pays the freight. Okay, so just be aware of that. I show both here, but in fact, in this problem, it was only the buyer who paid the freight. This was just an example in case the seller had to pay the freight. Okay. No, I'm sorry. This is both correct because they're both purchases. They're both correct. The buyer pays the freight, buyer pays the freight. And then when a purchase return, you can see it's just the reversal of the first entry, debit accounts payable, credit merchandise inventory. And then when they finally pay the bill, they only owe $1,270 because they started with $1,400, but they returned $130. So that's what they owe. They end up paying less cash because they got a 2% discount. Okay. All right. So let's go back to the practice exam. This is, so Kai Construction is a company, complete all journal entries. And the first question you ask when you have a test question or a homework question is it perpetual or periodic? Okay. So first question is, Kai purchased 10 windows, FOB destination. Okay, that's not shipping point. Okay, so be aware of that. From a window, net 30 from a window vendor, Pella, at $100 per window. Okay, so is Kai going to pay the freight or is Pella going to pay the freight? Who pays the freight in this transaction? So destination means, Colby, yeah, that destination means title transfers not until it arrives at its destination. So the seller owns it for the journey from the seller's factory to the buyer's business. So the seller has to pay the freight. So we don't have to worry about the freight bill here. So what's the journal? How much money did they buy? 10 windows at $100. That's $1,000 worth of windows. So what's the journal entry for a purchase using the perpetual inventory system? Debit inventory, credit accounts payable. Good, good, good. All right. Next one, Kai returns one window to Pella. Again, you're just reversing that first transaction. You're just gonna, the return transaction is here. So debit accounts payable, credit inventory, just the reversal of number one, okay? Kai pays the balance it owes. Now, the question you need to ask at this point is, go back to the payment terms above. 10 windows, FOB destination, we've already talked about that. 310 net 30. That means if Kai pays in 10 days, they get a 3% discount. Okay. So today is the 7th. And he's paying off on the 12th. So is he eligible for a discount? Yes or no? Put it in the chat. Yes, that's good. Okay, so he pays the balance it owes. Now we know the journal entry for payment is going to be debit accounts payable, credit cash, and that 3% is going to be a credit to inventory. So you can see the purchase, the return, if there's freight cost, if there's a discount, it all goes to inventory because it's either raising or lowering the cost of the inventory. And when we calculate the cost of the inventory, it's all the cost it takes to get the inventory ready to be used. Okay, so the accounts payable, the balance it owes from transaction 2 is going to be $1,000 minus $100. It's going to be $900. So debit $900. No, Colby, it doesn't matter the order, except that I prefer that you put the debit first. So in the payment entry, the debit would be accounts payable, but the credit is either cash and inventory. It doesn't matter on order. Okay. So they're debit to accounts payable, $900. What is 3% of $900? What is 3% of $900? $27. Sounds good to me. Okay, so $27 credit. And accounts payable debit 900. What do we credit the $27 to, Sophia, or anybody?
Inventory.
Correct. And then the balance goes to cash. So that will be 900 minus $27, which is 800 and what? $73, I think. Does that sound right? See if I can find the solution here. Oh, it's right here. Yeah, $900, $873 to cash, 27 to inventory. Okay, so those were all the purchase transactions, right? So see if I can move this off. There we go. Let me get a little smaller. Those are all the purchase returns. Now Kai is turning around and selling. Okay, so let's look at the selling transactions here. We'll stay with the perpetual. So when we sell, we have to do 2-line journal entry, 2 pairs of journal entries. Debit accounts receivable, which you're real familiar with, and credit sales. Why not service revenue? Because we're selling a product, and that means we're going to use sales. Okay, but then we also have to do this brand new journal entry. You can tell I'm a little tired. Debit cost of goods sold, credit inventory. And the problem has to give you the cost of goods sold. It either gives you as a percent. I think in some of the homework problems it said gave you gross margin. So then you had to calculate cost of goods sold, but it has to tell you, you can't just not have it. Okay, when the customer returns an item, debit sales returns and allowances. We don't debit sales. We have separate accounts, mainly because we want to track all that stuff. Okay, sales return allowances, credit accounts receivable, and then debit inventory, credit cost of goods sold. So the return transaction is almost the reverse of the first one, except we use sales returns and allowances. But everything else is reversed. Credit accounts receivable, debit inventory, we're putting that returned item back into inventory, and credit cost of goods sold. Okay, so if we go to the practice exam, we say, Kai sells 5 windows. Now you'll notice that the selling price is going to be higher. I mean, that's the whole goal in business, right? Buy low, sell high. And so sells 5 windows at $250 each. Terms are FOB destination. So that means the seller is paying the cost of the freight. Okay, so you're going to set up your journal entry, debit accounts receivable, credit sales, and that's going to be $250 times 5. Okay, but you still have to do the cost of goods sold and the inventory piece, debit cost of goods sold, credit inventory, and you're going to use your cost, which is $100, Kai's cost, which is $100 a window. So that's going to be cost of goods sold 500, merchandise inventory 500. The customer returns 2 windows and pays the balance owed. 1 or 2 entries is okay. So we're going to look at that. And let's take a look at that. So here was the sales transaction, debit AR, credit sales, cost of goods sold, inventory. Here's the return transaction. I showed it as 2 transactions. So the customer returned 2 windows, debit sales returns and allowances, 250 times 2, credit accounts receivable, debit inventory at cost, 200, cost of goods sold. And then here's where they're paying the bill. Now I go straight to accounts receivable here and you'll see $750. And that's the original amount that we sold, $1,250, less the 500 returned. So $750 was owed. Cash is not $750 because the customer gave us a 1%. We gave the customer a 1% discount. So just don't worry about pennies, just round that up. Should be $7.50, but okay to round. Okay. And finally, we get a freight bill. And the freight bill is $120. Kai, the seller, has to pay the freight bill because the terms were FOB destination. And now Kai is the seller, so Kai has to pay the bill. So it's going to be freight out and cash. Okay. All right. And then the next page is all the perpetual transactions. Okay. So let's just take a quick look at those. They're very similar. I said perpetual, I meant periodic. They're very similar, but with periodic, you don't have a real-time knowledge of what's in your inventory. You're just making purchases. And then once a year, you go out and you count your inventory and figure out the difference in that cost of goods sold calculation. The difference is cost of goods sold. So I always liken periodic journal entries. I always liken them to your own cash situation. If you open your wallet right now, does any of you have actual cash in your wallet? And if so, would you be willing to share how much you have in your wallet? How much do you have in your wallet right now? $10. All right, Sophia, thank you. I think I have 30, but I might be wrong. Okay, anybody have more than 10? Colby has 0. So you're doing everything by cards or Venmo. Beza has 4, thank you. Ben has $23. Great, I love this. All right, so let's say whatever you have in your wallet right now is your beginning inventory. And this is like the supplies problem. You go to the ATM machine and you get out, you go to the ATM and you get out $40, okay? You have money available to spend as the 40 plus whatever's in your wallet before you go to the ATM, okay? 3 days from now, you look in your wallet and you have $5. The difference is what you spent. Okay, do you guys see that? So let's say you started with, we'll use Ben's numbers, started with 23, add the 40 to it, you had money available to spend, 63, right? He went to the ATM. And then 3 days later, he has $5. How much did he spend? How much did Ben spend? How much did he spend? $58. Yes. Okay. So when we get to that calculation of cost of goods sold, it's similar to that. There are things you're going to add. There are things you're going to subtract, like purchase discounts or purchase returns. But the end result is it's only when you do that calculation, that's when you know what cost of goods sold is. Okay. So from there on, so in order to do the periodic journal entries, we don't use the inventory account. We use these other accounts. For a purchase, we use purchase. Accounts payable is the same for both. For freight, we use freight in, usually with 1 I, not 2, and cash. For purchase returns, we debit accounts payable. That's not new, but we use this new account, purchase returns and allowances. And then finally, when we pay the bill, it looks very similar, but again, instead of crediting inventory, we credit purchase discounts, okay? For the selling transactions, they are the same as the perpetual, except there's no entry for cost of goods sold, all right? So we come over here and we say, Martinez is a company. Book the periodic inventory system. Book the following journal entries. Calculate cost of goods sold, gross profit, and gross profit percentage. Okay. So Martinez placed an order from Seattle's door house. Martinez takes delivery of the doors. Okay. Craft builder purchased 10 doors. Martinez receives an allowance of 10% for defective doors that they bought from Seattle Door House. Martinez pays for doors delivered. Kraft, the customer, returns one door. So how do you do these problems? There's all these names flying around. So what I like to do at the top of my page is I like to say, company is Martinez. Okay. Seattle Door House is a vendor, is a supplier. That means the transactions between these two are going to involve accounts payable. Kraft Builder is a customer. That means the transactions with Kraft are going to involve accounts receivable. Okay, so don't get that mixed up. Try to keep them all straight in your head. Okay, Kraft Builders returns one door and pays its invoice. Okay, so you're going to see these same journal entries here. Debit purchases, credit accounts payable. The customer purchased doors. The first one was no entry, by the way. Is you guys comfortable with that? Martinez placed an order, but they didn't ship the order. So placing an order doesn't create an accounting transaction. Okay. So once the doors are delivered, debit purchase, credit accounts payable. Kraft purchased doors, debit accounts receivable, credit sales. Then Martinez receives an allowance of 10% for defect on doors. So when Martinez is receiving the allowance, that's from a buying transaction. So and they say it's from transaction 2. So debit accounts payable, credit purchase returns and allowances. And then Martinez pays for the doors, debit accounts payable, credit cash, credit purchase discounts. So the math is going to be the same for both sets of problems, perpetual and periodic. But what will be different for you is the actual accounts we use. And then in the sales transactions, we do not track cost of goods sold and inventory. Okay, so Kraft returns one door and pays for the invoice. That was combining 2 entries in one. If you did it as 2 entries, that's just fine. And then finally, optional, inventory, cost of goods sold, purchase returns and allowance. You don't need to be responsible for that piece. But down here you do. So how we calculate cost of goods sold. Beginning inventory plus purchases minus purchase allowances minus purchase discounts equals goods available for sale. So a little more complicated than your wallet and the ATM. But if you can think in those terms, it's all the purchase accounts. So start with the beginning balance, add the purchases, subtract the allowances and discounts, returns. This gives you the goods available for sale, the inventory available for sale. And then the only way you know what cost of goods sold is if you go out and physically take an inventory. And they did 16,129, and the difference equals cost of goods sold. Okay. Now I have a question for you guys. Has anybody ever taken physical inventory in the companies where you work? I have.
I actually just did this morning, so
Oh, good. What kind of store?
it's at a retail store.
I took a lot of inventories when I did retail, and I took a lot of inventory when I did manufacturing. I sat down one time and figured I'd done 50 inventories. They're pretty wild times. All right, so calculating gross margin, you take net sales. Sorry, there we go. Sales minus sales returns minus sales discount equals net sales, less the cost of goods sold is your gross margin, and gross margin percent is gross margin divided by net sales. Okay. Yeah, grocery store. How do you count the produce, Ben? How do you count the green stuff? Ben, are you there? How do you count inventory for a grocery store? I mean, I can see how you count the canned goods. We keep track of produce. Yes, absolutely, by weight. Yeah. And then do you have to say whether it's in good condition or going bad? Yeah, Nordstrom, you just scan, you go around with a gun, right, Leanne? And you just scan everything. Yeah, that's cool. Those really helped inventory a lot. But I'll tell you, when we used to do inventory, we close the factory or close the store and you just work until it's done. And sometimes it would take like till 10 o'clock at night. Usually we throw away anything that doesn't look good and we weigh the produce trash. Oh my. Can you tell us more about that? Do you have a microphone?
Yeah, I wouldn't be able to tell you guys too much about it because I've only really watched it once. But basically, like every day, just whenever they're doing whatever maintenance around the store, they'll have employees just looking at like the apples or whatever. And if they notice spots on the stuff, they'll just throw it in the trash bin.
And then you weigh the trash bin.
Yeah, so we weigh all of we divide our trash into like produce trash separate from all the other trash. And so we weigh all the produce trash, and then I guess whoever's in charge of recording all the numbers would create an estimate for how much that would be valued at.
So what if you have really expensive produce and then you have really cheap produce? Do you have to differentiate it? Like, I mean, some produce like real fancy fruit or I don't know.
Yeah, that's a good question. And I honestly don't know. I'm
like
sure they do somehow.
Goofy kind of yuppie lettuce or fancy elite radicchio stuff. It can be really pricey, but that is so interesting. I love inventory. I love any company that has inventory because I've worked so much with it. So I'm always going to ask you guys questions like this. Okay, so let's go back. We've got a few more minutes. This is, I believe, the multi-step income statement. And probably areas of, yeah, oh boy, this is a lovely one, all scrambled up. So you have to sort out what's what. So they're asking for multi-step, okay? They are not asking for a balance sheet. They are just saying, give us a multi-step income statement. But you've got balance sheet items in here. So be really ready to not use the balance sheet items. Sales, cost of sales, that's another name for cost of goods sold. Buildings, we don't want that. So we want the sales. Let's just highlight what we want. Cost of sales. Nope, it's not going to do it. I knew it. Salary expense, we want that. Rent expense, we want that. Loss, we want that. Advertising, we want that. Interest expense, we want it. Assume a 21% sales tax. Okay. All right. So I have them all. Let's go back. Oh, sales discounts, sales returns and allowances, advertising expense. Did I read all those? Okay. So don't mix up purchase and sales. Okay. You only need the sales in the multi-step income statement. Things like purchases you need for calculating cost of goods sold. So you're only going to use sales, sales discounts, sales returns. Remember to subtract those two to get to your net sales. Then because we're perpetual, we just have an answer for cost of goods sold. When we get to periodic, we have to do the long calculation. And then here's all your operating expenses. So I want to draw your attention to operating expenses are the things that a company does in its normal course of business. Oh, thanks, Sophia. That's interesting. Yeah, you have to count the fridge items. And if you work at like a Subway, you have to count the deli items as well. Okay. So salary, you pay your employees a salary. Rent, you have a building. Depreciation expense, you have equipment in that building. Advertising expense. Okay. That leads you up to income from operations. And the one I don't have here, if you have freight out expense, that would be here too under operating. Why? Because when you ship to a customer, in order to complete that sale, if you, the company, the seller, are paying the freight bill, you have to ship it in order to end your sale, to finalize your sale. And so it's a cost of your regular course of business. Okay. So freight out would be an operating expense. Now down here, other income expenses. Those are where you'll see interest revenue, interest expense. You subtract interest expense. If you had interest revenue, you'd add it. And then if you have any losses or gains, you'd put them there as well. Those are the expenses that aren't part of normal operations. They're the unusual items, but they're not what you do on a daily basis. Okay. Then you get income before tax, calculate your income tax, and come down to net income. All right. All right, and then that's the other statements that we don't need for this exam. Okay, and then here was the question of calculating all the missing amounts. And then I think many of you did that on the practice exam. And then finally, we have this calculating cost of goods sold. Okay. And where did it go? It went somewhere down here. Okay. So imagine getting a list of accounts. You've got freight out and you've got freight in. Okay. Freight in is part of cost of goods sold because you're saying this is what it took to get the inventory ready to be sold. Freight out is under operating expenses. So we don't include freight out here. We just include freight in for cost of goods sold. All right. So beginning inventory plus the purchases, minus the discounts, minus the purchase returns and allowances. So beginning inventory plus purchases, plus freight in, minus purchase discounts, minus purchase returns and allowances. That's 5 accounts. Okay. That adds up to goods available for sale. And then you subtract ending inventory and you get cost of goods sold. So let's look at the solution. Beginning inventory plus purchases. And if you doubt, you can see it. Think of your trial balance. Think of your trial balance and you'll see inventory is a debit balance. Purchases are a debit balance. So you add those together. Purchase returns and allowances, purchase discounts are credit balances, so you subtract them. Freight in is a debit balance, so you add that. So add them all up, you get goods available for sale, and then you subtract ending inventory. So an area on this question where students make mistakes is instead of saying beginning inventory, it might have a date, and instead of saying ending inventory, it might have a date. And students sometimes switch them. So just be aware, whatever date is the earlier date is beginning inventory, and whatever date is the later date is ending inventory. Okay. All right, I think that's just about it. There's some more, I think, solutions, but I'm not sure I gave you the problems. Let's see if I did. Did I give you one more set? Oh, I gave you one more set of problems down here, but I think you guys have the idea. Okay. Do you have any other questions for me on the exam? That was like a 1-hour cram there. Anything else you want to go over before we call it quits? All right. You guys are asking good questions. Can I do? Yes, you can, Ben. Just stick around. We'll do, if you haven't done your exam conference yet, just stick around and I'll make some time. And I think it'll be Ben first, and then I think John is going to do a conference as well. And then Leanne, are you able to stay?
I actually have to go soon, so if anything, I can just do it a different day.
You can, I'll post your grades. Your grade wasn't posted yet. I picked up your exam. Yeah, Sophia, that's fine. I'll post your grades tonight, and then I'll bring your exam to the exam tomorrow, and you can take a look at it. How about that?
Okay, yeah, that'd be perfect.
Okay, I'll see you tomorrow.
Thank
Okay,
you.
so it'll be Ben first, then I'm gonna Ben, and then John, and who else was, and Sophia. I keep calling you Sophie. I apologize. So, I know a Sophie. So, all right.
It's okay, it's cute.
Yeah, but it's not your name. It's my nickname for you, which is so inappropriate. Okay. So, all right, Ben, I'm going to open up a breakout room and I'm going to shut this. I'm going to stop the recording.